Hi, everyone, and welcome to our Victory Virtual New Year, New Insights. If you're anything like me, you're probably looking for insights to help you manage your investments in 2023. But time is limited, as we all know these days, and we don't necessarily have all the time in the world to watch the news or read the news to help us plan. And that's why Victory Capital is here to help. We're glad all of you have joined us today, and we're excited to share our new event format with you. We've taken some of your top questions that you submitted upon registration, and we have our experts here with us today answering them. And the thought behind this is that we can provide you with insights that matter to you. And we're confident that any investor, regardless of where they are in their journey, will get something out of this event. So what's ahead of us today? I'll make some introductions and then dive into a new and helpful resource that's available to you. And then our experts will answer your top questions about what's happening in the markets, the why behind it, how we're responding, and then they'll share some insights on what investors might be able to do. And before we get started, thank you to the many of you who submitted your questions through registration. We selected some of your questions to answer today, but for those of you who didn't get their questions answered during today's event, we'll reach out to you to answer them individually. And of course, if you think of something after the event, don't hesitate to call us at the number on the screen. Our representatives are available to help. And briefly, before I move on, I wanted to share a little bit about Victory Capital with you. We are a diversified global asset management firm with $153 billion in assets under management as of December 31st, 2022. We're publicly traded on NASDAQ, and our ticker is VCTR. And we serve clients ranging from individual investors to financial advisors to institution pension plans, all with access to the same investment expertise. And now, who are our experts? I will first introduce myself. My name is Krista DeSerio, and I'm your host today, as well as Channel Marketing Director for the Direct Investor business here at Victory Capital. Joining us today are experts Thomas Allman, West Point graduate, Army veteran, and Senior Investment Analyst for the Victory Capital Solutions team. Also returning to us is Jim Jackson, Victory Capital Head of Fixed Income Portfolio Management with USAA Investments, of Victory Capital Investment Franchise, and a graduate of the Naval Academy and veteran of the Marine Corps. And last but not least, we have Derek Cattell with us. He is Head of Sales for the Direct Investor business. Welcome, gentlemen, and thank you for joining me for this discussion. Now let's move into answering some of our most pressing questions that you all asked upon registration. And really, we could spend all day talking about what happened in the market within the last quarter or the past year. But today, we want to focus on helping you understand the why. So without further ado, our first question is from Ernest, one of our investors from Virginia. And he asked, why have the markets been so volatile recently? Thomas, what are your thoughts?
Thank you, Krista, and thank you for having us. And I am going to answer that question, but first I do want to review 2022. You can see that major indices were down across both equities and fixed income. However, you can also see in blue that for the quarter, those indices were positive. Let's directly answer that question on the next slide. So what drove the volatility in 2022? And first, the valuations. When we were coming out of COVID and through 2021, some companies, most notably those growth companies, had very high valuations relative to their histories. So the starting point really does matter. However, in 2022, we saw those growth companies do much poorer than their value counterparts. The second key point is we saw the damaging effects inflation can have, and that's not just on markets, but on everyday life. So for example, groceries, buying a new home, or taking out a new loan became more expensive. In the response to inflation from the Federal Reserve, they raised their target rate, caused concern for some investors, which led to sell-offs in both equities and fixed income.
Yeah, Thomas, that certainly impacted us here in the US, but what about the rest of the world?
Yes, lastly, we're part of a global economy. So Russia's invasion of Ukraine caused effects throughout the world. In addition to that, the prolonged issues from COVID across the globe caused many supply chain issues.
So tell me, what exactly did this mean or does it mean for our investors?
For investors, 2022 unfortunately provides the opportunity to reassess risk tolerance. And so for some investors, they found that they weren't comfortable with that level of market volatility. The good news is that they can take that new understanding of their behavior and apply it to their portfolios going forward. The other key point is that it shows that markets don't always act like we expect them to. So there's no iron rule that says bonds must zig while stocks zag. Markets can be very unpredictable.
Very helpful, Thomas. Thank you for that perspective. And now on to our next question that addresses the fixed income market. Theo from Indiana asked us, how come the fixed income market moved around so much this year? And Jim, I think this is a perfect question for you.
Thank you, and thank you for the excellent question. So very difficult year for fixed income in 2022, and it was primarily driven by higher rates. So in response to higher inflation, the Federal Reserve increased what is called the Fed funds rate at the fastest pace that we have seen in multiple decades. As you can see from this chart, the green line shows the current Fed rate hike cycle. The slope is at a steeper angle than the previous three. This fast pace is really why markets reacted in 2022.
So, Jim, what do these higher rates mean exactly?
Sure. When the Fed raises rates, it really directly raises what is called the Fed funds rate, which is the rate that banks lend to each other on an overnight basis. What that means is that that will raise the cost of borrowing across the banking and across markets. So for you, what that means is that you will pay higher rates on loans. For bondholders, it means that the rates on the bonds that they hold go up and the rates on new bonds go up as well. So really, when the Fed started to increase its rates, it did so in response to higher inflation. So as we'll see on the next chart, what we really saw is inflation start to increase in 2021, and it really started to increase in 2022. There were a lot of things that drove this, from supply chain issues, from fiscal spending, from labor market. All of these really combined to drive inflation higher in 2022.
So Jim, if you dive beneath the headline inflation numbers, are costs rising all across the board?
Not evenly. As we see in this chart, this is basically showing in broad terms, the drivers in 2022. So at the start of the year, services and goods contributed about the same to the increase in inflation, but this diverged throughout the year. So what we saw is the price of goods, its growth started to slow, or at least the pace of price increases in goods started to grow, and in services, it started to go up. So what we saw this year is really this, the prices of these two really started to separate from one another as far as drivers of CPI.
Thank you for that, Jim. Now, our next question is from Audra, an investor who's a fellow Texan, and she asked a question that's on all of our minds. Will the markets recover in 2023? And as tough as a question as that is why we're all here. So Thomas, why don't you please share a little bit of your perspective on how investors should think about this question?
Yeah, the first thing I'll say is that we don't really look at 1 year as a great sample size. So you really want to be able to look at investing as a longer term journey, but we will try to answer that question directly. And it's important to note that past performance does not predict future results. Here we have 50 years of the S&P 500 index, which had 11 years of negative returns. In that following year, markets were negative only 3 times. And again, we believe that a 1 year time horizon is too short to judge market performance. If anything, this chart should serve as a reminder that investors need to focus on the long term And it's also a good reminder of why we should stay diversified so we have exposure to different asset classes. So even though there's going to be years like 2022 that some asset classes are going to be negative at the same time, over longer periods of time, diversification can still add balance to a portfolio. Let's zoom out a little bit and look at longer time horizons on that next slide. This is a chart showing the S&P 500 index over the last 50 years, taking rolling time periods. So for example, since 1971, over any 10-year period, the S&P 500 index was positive, which just means it had a return greater than zero. It's also helpful to note that we can add diversification to our portfolios so we're not reliant on just one asset class.
Now, Thomas, for some of our investors who are just getting started, could you give a hypothetical example of what a diversified portfolio might look like? And let's just say I'm an investor who's just starting out and is mainly invested in a cash equivalent like a money market fund. What might diversification look like for me?
Yeah, that's a really good question, Krista, and it's something that I could talk about for hours. At the most basic level, investors should know three things, and that's going to be their goal, their time horizon, and their risk tolerance. With those three things, you can start to construct a portfolio. And for diversification, some combination of global equities and fixed income is going to be a common starting point. However, fixed income markets haven't had the same experience in the last year and are looking different going forward. Isn't that correct, Jim?
Yes, thank you, Thomas. What this chart is showing is that it really shows how the magnitude of the dislocation in bond prices in 2022. So when higher interest rates result in lower bond prices, so the blue line here represents the yield of the US bond market. You can see that from 1999 through 2021, the yield operated within a fairly narrow range, and so did the price. You can see when yields started to increase during 2022, we saw the price come down. These types of dramatic moves in the bond market tend to happen fairly infrequently.
Jim, that makes sense. But tell me a little bit about potential opportunities it could create for our investors.
Excellent question. One indicator of expected returns for bonds is the starting yield at which you invest. So the challenges experienced by the bond market in 2022 have a silver lining in that starting yields have improved. So what this chart shows is really three broad segments of the bond market. On the far left side is the federal funds rate, which is designed to be the very short end of the bond market, often represented in money market instruments. The center portion is the US bond market as a whole, and the far right is the tax-exempt muni bond market. So as you can see here, the yields on offer now are well in excess of the average offered over the last 10 years.
Thank you, Jim. And I know this is second nature to you, but for some of our investors that are here with us today and are interested in learning more, I do want to remind them that you did cover this, Jim, in the last Victory Virtual, and it is available for all of our investors today for them to watch at their convenience. They can find it on our website at vcm.com. Now, Jim, it looks like we have another fixed income question for you. This one is from Joseph out of California, and here's what he said. I'm 50 years old and a long-term fixed income investor. How are you all responding to the market?
Sure, I will start with, we continue to follow our time-tested process that we have honed over 50 years. So we very much focus on calibrating the credit risk that we're taking. We have an experienced credit research team that evaluates every single bond that we buy to assess risk versus reward. And we maintain a very diverse portfolios that invest in a lot of different fixed income asset classes. Of course, that is driven by what the actual mandate of the fund is.
Thanks, Jim. I appreciate you covering how the USA investment team evaluates portfolios, and just really appreciate your views on fixed income. And thank you to you as well, Thomas. Thank you both for joining us, and we'll see you next quarter. And next up is a question from Shayna out of the Rocky Mountain State. She wants to know how we're changing portfolios for 2023. Derek, I'll toss this one to you.
You know, Krista, that is a great question. And just to start, our asset allocation models are reviewed regularly to reflect market conditions. These are then reflected in our allocation outlook. And as you heard from Jim and Thomas, there are multiple factors affecting the investing market. First, when it comes to risk, currently we're taking a neutral stance toward risk, meaning we're not taking more risk, but we're not taking all risk off of the table either. This means that we're moving away from some higher risk equities with weaker growth expected, as Thomas mentioned earlier. When it comes to duration reflects what Jim was discussing about managing volatility in bonds. With the Federal Reserve still raising rates, that still creates the potential for more volatility in our current environment. Our portfolios are currently favoring shorter maturity bonds that reflect a lower duration to help with volatility and still provide some relatively attractive yields. Credit quality. Credit quality is a reflection of the issuer. For example, the US federal government is an example of the highest credit rating at AAA, and then it goes down from there. We're selectively adding some lower credit bonds that have become attractive as the income seems more attractive, especially in shorter maturity bonds.
Thanks for that, Derek. And why don't you tell me a little bit about how we're positioning assets?
You know, I'm glad you asked, but before I jump in, just want to highlight that this is not an investment recommendation. This is simply an explanation of how we are allocating assets within our allocation portfolios. So starting with US large cap stocks, we are currently underweight. We base that opinion on several potential headwinds, including the Federal Reserve raising rates and how that is going to impact earnings for these larger companies. Second, on small cap stocks, we're neutral. As an asset class, they're attractive on a short-term basis, meaning 3 months to a year. But on a long-term basis, we see opportunities elsewhere. Looking overseas, developed international markets are also neutral. Developed international markets are larger established economies like Germany, Australia, and Japan. Several international markets have already entered a recession and face further issues, especially with a stronger US dollar compared to their home currencies. Emerging markets are also neutral. Emerging markets are international economies that are growing or emerging. These are economies like Brazil, China, and Mexico. Their valuations are cheap relative to other markets, but they can also be impacted by a strong US dollar and geopolitical turmoil.
Now, Derek, what about fixed income?
On the fixed income side, we are neutral on core bonds. As Jim discussed, with the Fed raising rates, short maturity bonds have reflected those rate increases with rising yields. And they can also provide some protection from volatility, especially relative to longer maturities. High yield is overweight. The yield difference between investment grade and high yield income has widened, leading to some attractive income. However, with a higher probability of an economic recession, that also leads to a higher risk of these bonds defaulting, as these issuers generally have a lower credit rating.
Interesting and very detailed, Derek. Thank you for walking us through that. And let's see, our next question will likely be helpful to a lot of you. Lenore from South Carolina wants to know if there are any investment contribution changes she should be aware of for 2023.
You know, Lenore, we actually have good news there, and the IRS has increased contribution limits for 2023. This is the first time they have done that since 2018. So for example, for an IRA, you can now contribute $6,500, up from $6,000 last year. If you're over 50 years old, the catch-up contribution has not changed. That is still $1,000. For retirement plans like a 401k, thrift savings plan, 403b, most 457s, you can now contribute $22,500. That is up from $20,500 the previous year. The catch-up contribution, if you're over 50, is an additional $7,500, which leads to a maximum contribution of $30,000 per year. Another important increase is the gifting limit. The increase is an additional $1,000 to $17,000 per person. This is especially important for those that are gifting assets to others, like in a 529 plan, for example.
Well, thanks to you for covering this, Derek, and to Lenore for asking such a helpful question. It's great for all of us to be walked through this by you. And also to remind everybody here with us today, all of this information will be available to you after our event, and you can look for that also on our website. Let's see, last but not least today, Hiram, one of our investors from New York, wants to know how he might be able to start preparing for tax day. And good news for you, Hiram, our tax center has many helpful resources that can help all of you here with us today, your family and friends, start preparing for tax day. And Derek, why don't you take us through a few of those resources?
You know, our tax center features everything from articles to calculators to important schedules. Let's start with a few examples of ways you can start preparing. First, make sure you have a comprehensive understanding of all the documents you'll need to prepare your tax return. There's different types of documents, like forms to organize your income, forms that you use to report your deductions, documents you may want to keep if you itemize your deductions, for example.
Well, it sounds like I have some homework to do, but tell me about some items that our investors can expect to receive from Victory Capital.
Yeah, I'm glad you asked that. There are several tax forms that our investors can expect to receive. You'll see a list, a few of the examples here, along with corresponding dates of availability. You can find a list of documents needed to prepare your tax return, an outline of how investments are taxed, plus a tax form delivery schedule and more in our tax center.
Thank you, Derek, for walking us through that. I hope that all of you who have joined us can take advantage of these resources and that tax day is a little less taxing for you this year. And again, if we didn't get to your question, we'll reach out to you directly to get your questions answered. If you have any remaining questions today after the event, don't hesitate to call us at the number on the screen. Our representatives are available to assist you. And lastly, don't forget to follow us on social media for all of the latest updates. Thank you all for attending our Victory Virtual today. Our materials will be available for you on our website soon, so please be on the lookout. We really do hope you found these insights today helpful, and we look forward to seeing all of you at our next event. Have a great day.